Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to jump on Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in. We're going to take a look and see what people are sharing. If you want to follow me at Finding_Finance, and if you want to join our community, finding-value.com. We've got a question and answer session that is occurring right now. It started at 7 a.m., just like this video starts at. And if you're from 7 to about 11 a.m. in the morning for Mountain Time, we'll be on there answering questions if you guys have any sorts of questions. And we'll be looking at some charts. We'll be looking at going through some of the macro stuff. And I'll show you and share my opinions like I have been over the past few weeks. So Eric Nuttall, looking for some good news on a miserable macro-induced risk-off day heading into a long weekend. Net speculative length has fallen to a level, close to a level, which historically has equaled a bottom in the oil price. Now, we very well could be getting real low in these net speculative positions, but the macro does throw these assets around. And if people are selling things, sometimes they are forced to sell whatever they've got, irrespective of how good the fundamentals are of the sector itself. So yeah, the macro does dominate. That's probably 50 to 60% of the move. Then the individual sector is probably 30% or so. And then the rest is individual companies and stuff like that within the sector. Coming down, China, 10-year bond yields at all-time low. They're talking about deflation for China. Now, why does that matter and where did it come from? It comes from the real estate market, and it comes from their demographics falling off a cliff in home buying years. This is what a real estate bubble and the popping of it looks like. They just don't have the demographic to throw the homes at. So what occurs is much like Japan, is you get this very low inflation or deflation or disinflation, however you want to call it, depending on what environment you're in. And that's what's driving it is the demographics. So I don't know how they're going to get out of it. Like you're going to have the population grow. Investment wisdom. During such scary periods, you should never forget two things. First, widespread fear is your friend as an investor, because it serves up bargain purchases. Second, personal fear is your enemy, says Warren Buffett. So again, make sense of this. Your personal fear is your enemy, and widespread fear is your friend, because this is where you get the big outsized returns if you can pony up the balls to buy at these lows. Now, I'm not saying to buy at the exact lows that we're at today. We'll have to see what some follow through looks like. But you got to take the opposite view and buy assets when they're undervalued and fears in the market. I did that in 2020, and it was probably, well, it was my biggest returns in the shortest period of time. I do think that there's probably going to be fear ahead of us. I agree with that because the 2-year yield could fall and has some room to fall further. But we'll see. We'll have to wait and see. We'll have to see what the follow through looks like. We'll have to look at the VIX because the VIX did break out, and I probably should share that. And maybe someone did share it, and I reposted it. But VIX did break out, and there's certain things that we can watch. Your opportunity comes from everyone else getting fearful. That is your opportunity. You act opposite of everyone else, and you take and steal those shares from other people that are willing and able to sell them to you because of they are only fearful because the price is moving lower. That's the only reason. And the emotions overwhelm them. Their personal fear is your enemy. Those emotions overwhelm them and they get scared. Momentum structural analysis. He says, just a little history lesson. In August of 2007, silver began a nearly 100% upside rally. The first rate cut came just a few weeks into the rally in September of 2007, and they continued cutting multiple times. Silver and gold finally joined in with the stock market in 2008, but only after rallying and making new highs. The arrows on the chart indicate the weeks when they cut rates. Cut, 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 and then they cut it back here, and the whole market grabbed them lower. So the front run of this, gold and silver take off. And that's how we've positioned in some of this stuff. Tavi says the track record of this indicator continues to be impeccable in forecasting recessions and severe downturns in labor markets. To reiterate, now may not be the time to ignore the steepening of the yield curve from its deeply inverted levels, as the unemployment rate also is heading higher here. That does mean that we are likely to hit a recession. And what is the accuracy of this measuring stick? And if you combine it with the yield curve on inverting, it's pretty much nuts on. So times when the unemployment rate crossed above its 24-month moving average, and this is your U3 unemployment rate. So we had a recession as this comes on up every single time in history. So we very well could be heading towards a slowdown. Now, just because we're heading towards a slowdown and there's a recession, the markets front run it. You'll see the 2-year yield drop like a rock, like we've been seeing. You'll see a lot of selling pressure in the stock market, exactly like we're seeing. You're going to see the S&P 500 VIX break out, exactly like we saw and are seeing. And then you have to figure out, well, how long is this going to last? Usually it's pretty intense selling pressure in the beginning. Generally, you get like a double bottom or something like that. And we'll pick off our favorite, most leveraged companies in the most hated sectors, because the ones that fall the most give you generally the best opportunities. And there is a cycle that you can use where you can do a rotation between this asset and that other asset. And I'll share all that on the website question and answer session coming up. Semiconductors, what leads fake bull markets ends them. So pay attention here, and this is the semiconductor, and we've got lots of selling pressure here that looks like it could potentially head lower, maybe do a retest, and then a move on lower. So that's the semiconductors SOX ETF, I think. From the Great Marty. The SAHM rule. So the SAHM rule recession indicator triggered in July. Fed Chair Powell said it's not an economic rule, but a statistical regularity. In any event, here we are. And this is where we generally get those recessions, when it passes the 0.5% level, which we just passed. So we passed it, recession, passed it, recession, 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 every single time almost. David Rosenberg, unemployment rate, the SAHM rule triggered the recession call today. The chart here shows that the plus 80 basis point jump in the jobless rate over the past year is a 100% ironclad indicator. The downturn has either arrived or about to. The Fed is behind the economic curve now, and it was behind the inflation curve back in 21-22. Most of this tightening phase and cyclical bear market in bonds is set to unwind in dramatic fashion, in his opinion. The Pring Inflation Index on the weekly, he says, and this thing looks like it's ready to break out. We better throw us into recession before this thing breaks out, right? That's what Powell's up against. He's pinned between inflation and unemployment and that slowdown of the uninversion of the yield curve. So the slowdown and inflation, those are not a good mix. So he's like, how do I control both? He can't. He can't control inflation and improve unemployment, I think, at the same time. Because, I mean, he has to do stimulus or something and hold interest rates high, or increase interest rates even higher than where they're at today. So he's in a difficult spot, very difficult spot. The Kobayashi letter breaking. Japan's stock market, the Nikkei 225, ends the day down minus 6% and officially posts its largest daily drop since March 2020. In the US, the 10-year note yield is now down 40 basis points in 1 week. Markets are pricing in a recession. They are. And generally, the beginning of a market move lower, you get these large selling pressure moves. A big bearish engulfing is what they are called. And we're getting that. So you can't make this up. The June and May jobs reports were just revised lower by an additional 29,000 jobs. 5 out of the last 6 job reports have now been revised lower per zero hedge. In fact, 10 out of the last 14 job reports have been revised lower. Not only is the unemployment now at a 3-year high, but revisions are the new normal. Hundreds of thousands of jobs have been revised lower just in 2024 so far. What is happening here? Well, they're cooking the books here, guys. They're given the initial jobs, report, and then they go back and revise it lower. So it's probably done on purpose to manipulate the markets as best they can. Here's Grady, and I do like looking at this chart. I'm going to go over it. He says, I see and meet so many that have made it their mission to be against the precious metals. Try to tell them to stop that stubborn, non-value adding behavior and get your head straight, or you'll miss the greatest wealth transfer in history. Could have, should have. It is actually imperative to realize that your future life depends on making the most out of this precious metals bull market. I posted this chart before, first time back in 2019, and it's still showing the way. Got another blue mega breakout 6 months ago. Bull market price objective is between 10 and 15,000, but it could briefly go much higher at the end of the bull. So this is what he's got, this big, we're breaking all these blue downward facing patterns, and it just keeps ripping higher. It says, note that the Kondratiev macro cycle is so-called long cycle and is not to be mixed up with the comprehensive technical tools cycles analysis. Examples of other long cycles are the 15-year commodity cycle plus the 18-year debt cycle. This is the fifth wave. The fifth Kondratiev wave. K waves have lasted 54 years on average. And we're going to come somewhere up to this peak here. This is a possible time span, which is in the green here, for the fifth K wave to top. If it's right translated, then we top beyond 2028, which would be very reasonable for this bull market. And we top in 2034 if the fifth K wave is similar to the fourth K wave. So here we go. And gold could be an absolute ripper here. Now, somebody did ask me, well, I'll go over that during the question and answer session. I don't want to share that here. Here's ExxonMobil closing out the month on its highest levels in history. Fun fact, this is the largest direct descendant of John D. Rockefeller Standard Oil, founded over 140 years ago. And here we are at almost all new all-time highs. I'm sure it was down today to sell everything event, but this still looks very well positioned to move higher, not lower. We're sitting on top of resistance and on top of support, which was former resistance. So this is going to be a very interesting thing as we go through a potential recession slowdown. And Powell is probably driving this because he sees these charts out there going, oh my God, I got to kill this. He probably sees the setup in crude oil, but I think what he's going to create is just a big slingshot where they pull on back and then they rip to the opposite side. He could also be providing his buddies an entry point, the banks. So don't get scared. Don't give your shares to the banks or these guys that part of the insiders. Hold on. Buy more if you can at cheap prices, and let's rip this thing together. That's what I'll say. So cross-border capital, he says, soft economy, no surprise given previous liquidity squeeze. Policymakers likely do not understand the lags. They've been too slow to ease, especially given derailment of the Chinese economic locomotive. This is total liquidity index is going up, but the Eurozone business activity continues to decline. We've got those two kind of at crossroads here. Peter Schiff, the U6 unemployment rate spiked to 7.8% in July. Prior to 94, the U6 rate was the official rate. During the 53 years from 41 to 94, there wasn't a single year when unemployment ended as high or higher than it is now. It says this is one of the weakest labor markets in history. So that's why we've got a potential slowdown recession that we've been going through, I think, and is starting to maybe intensify. I can't hide it any longer. Here's the NASDAQ. It says, do I have your attention? The Great Marty. A breach of 17,100 and it's a bloodbath. Don't panic. It gets much, much worse. Here's the big reversal candlestick there. At the top, that's a bearish engulfing. Then we started selling off. These big red candlesticks are generally the beginning of a move lower. It's the red army is what I call it. So this could very well continue lower, and I think he posted this one 14 hours ago, so it did continue lower. The IXIC and it's breaking to the downside. Jesse Felder, the number of active U.S. rigs drilling for oil, it is really, really low. I do think we'll bottom out here probably late 2024 at some point. Great entry point is what I think. And if the oil price continues lower and natural gas price, because of a potential recession, man, this really sets up for a big move on the opposite side of this slowdown. So I think this is going to set us up really well for incredible entry points in a lot of different sectors here. But we're going to have to go through some pain, I think, hopefully it's not too long, but we might have to go through some pain in the short term here before that bottoms and turns. Brady says, for gold and silver are the counterweights versus the defended global fiat monetary system, and it's dying. So it should be obvious not to expect this bull to be easy. Expect it to be hard, very hard. And do not get disappointed, i.e. emotional. Understand it instead. Mindset is key. And that's going back to what I just read up at the top there with Warren Buffett's quote. Do not have personal fear. You gotta put that in the back seat. You cannot be scared out of these stocks. And I've got another quote coming. You got to use the fear in the market to your advantage, and that's where you make all the money. Patrick Karam, I really do like this chart here, guys. This is probably my favorite chart. So most traders can't understand that a rock can outperform U.S. equities. A lesson's to be taught once again to the new generation of traders. He's talking about gold versus U.S. equities. This is really, really important to understand. When gold starts to outperform at these levels here, you get the commodity bull markets. We were at the beginning of this bull market here. 2020, yeah, it was the bottom, but we didn't really break out against the S&P 500 or tech stocks. And right now, we are lining up for that. The market conditions are coming for gold to outperform U.S. equities. It's all in alignment right now. And this is when gold and silver miners do really, really well. So everything is in alignment for this outperformance right now. Now, could we get a slowdown that goes sideways or pull us a little bit lower? We could. And that will always occur at the beginning of these big bull markets. But if you can get in when things are down and you can somewhat time a good entry point, you may not be perfect. I'm not perfect. No one is. But if you can somewhat time it and you ride the majority of this move higher, it will change your life. It changed my life. I rode it for the majority of that move in 2020, and all that was this little move here. The big move's coming. And I rotated into energy after gold and silver bottomed in 2020. I played it quite well, not really on total purpose. I'll just say that I did very well. I timed it very well. And I have a feeling that the same thing's going to come again here. So everything looks really good for a huge outperformance of gold versus U.S. equities, and this is the time the commodity bull market goes. We are right at the beginning of it. And I am definitely going to partake in this. Definitely. So it's coming. Non-farm payrolls, despite the overall weak report, residential construction payrolls continue to make news cycle highs. This has also been the beginning of bull markets, are these big real estate cycle moves in an expansion phase. So we are getting what is perceived to be a slowdown in the market. The 2-year yield's dropping. It's going to front run the lowering of interest rates, and construction is still at very good levels. It's not being driven by the real estate market. And housing starts are doing the same thing that it did in the early 2000s. We get this sideways action, and then we'll get a breakout. And I think that breakout will occur when the interest rates go lower. So that's something we're all watching. And all of these things are in alignment for a big commodity bull market to come. And that's in the exact stage of the real estate cycle that the commodity bull market, in fact, comes in. We've got Mike Zaccardi says, historically, there are three types of Fed cuts. There's panic cuts, soft cuts, and hard cuts. So let's go over these real quick. Panic cuts like 87 and 98 are positive for stocks if the event does not impact Main Street. Soft cuts like 84, 95, and 19, they're positive for both stocks and bonds. And hard cuts, 73, 74, 80, 81, 89, 2001, and 2007 are negative for stocks but positive for bonds. And that does look, well, whatever cut it is, it does look positive for bonds right now. They're breaking out. And the stocks have been pretty weak here. So that's kind of what he's got in the panic cut, soft cut, and hard cuts, and when those were good during those time frames. Here's another quote from Warren Buffett. People tend to underestimate low probability events when they haven't happened recently, and they overestimate them when they have happened recently. That is the nature of human animal. Another one from Cross Border, he says, the Fed playing a dangerous liquidity game. Bank reserves are falling into a gray zone where tensions can rise. Projections take latest QRA at face value. You can see this is the adequate reserve level. We're coming into these levels where we might be falling out of adequate reserves, in his opinion. Then coming down here, one of two. I thought it was, where's two of two? Two of two. All right, coming down, and then we've got gold versus the CPI, game on, and gold's breaking out of CPI. What does that mean? It means that gold is in the great market condition. It's in a good market condition for gold to go up, and the inflation is not that high. This is just signaling where we're at in the cycle. We got a nice big breakout here. And then I posted here, it says, the real key to making money in stocks is to not get scared out of them. That's the real key. To not get scared out of them. So don't be too scared, guys. Don't be too scared. But that's where I'm going to end it, guys. Give me a thumb up for the content. Subscribe to the channel. We've got the question and answer session going on right now. If it's in the morning of Saturday, between 7 a.m. and I'd say 10:30 a.m. 7 and 10 a.m. is probably what I would say. And that's when we usually hold it, Mountain Time. But that's what I've got for today. We'll catch you next time. This is Finding Value.